Today we're doing a full deep dive into Tesla's Q2 2025 earnings. We'll unpack the numbers, highlight critical takeaways, and talk about where Musk is steering the company next. Stick around. This is a big one. Alright, first up. The top-line numbers. Tesla reported $22.5 billion in revenue, a 12% drop year. This marks the steepest decline in over a decade. GAAP net income came in at $1.2 billion, down 16%. Non-GAAP EPS was 40 cents, right at consensus. Operating margin was crushed, falling to 4.1%, down by 219 basis points. That's a major hit for a company used to double-digit margins. Let's talk cash flow. Free cash flow collapsed to approximately $100 to $146 million, down nearly 89% year. That's a sharp slowdown for a business of this scale. On the bright side, Tesla's sitting on about $36.8 billion in cash, a sizable war chest to weather stormy seas, production, and deliveries. In Q2, Tesla built 410,244 vehicles, flat versus last year, and delivered 384,122, a 13 to 14% year-over-year drop. Energy storage units hit 9.6 gigawatt-hours, up 2%. This is actually one of Tesla's highest energy storage deployments to date, signaling continued strength in Megapack and Powerwall sales, and a smaller but growing revenue stream. Services and other reached $3 billion, up 17%. What's driving the decline? Three main factors. Cooling auto demand. Average selling prices, or ASPs, dipped due to mix shifts and aggressive discounting as Tesla tries to move volume in a tougher market. Regulatory credit revenue shrank significantly, down by more than half to $439 million this quarter, and is projected to decline further as incentives phase out. Global competition ramping up, especially from Chinese EV manufacturers like BYD and Xiaomi, who are increasingly preferred by Chinese consumers. Tesla is responding with heavy discounting and incentives to move volume, which is directly impacting their automotive gross margins. But it's not all doom and gloom. Tesla continues to pivot strategically. The Robotaxi pilot in Austin is well underway, with over 7,000 miles driven and no notable safety interventions, opening the door to fleet-based revenue. Expansion to other major U.S. cities like San Francisco, Nevada, Arizona, and Florida is pending regulatory approval, with plans to cover half the U.S. population by year. The low-cost model, likely the long-awaited Model 2, or simplified versions of Model 3, with a significant ramp expected in the second half of 2025. Cybercab and Robotaxi production is targeting 2026, with Musk projecting sub-30 cent per mile economics for purpose-built vehicles. Plus, AI-driven Autonomy and Optimus continue to get significant funding. Tesla now utilizes compute power equivalent to 67,000 H100 GPUs for its AI development, showcasing a massive investment in this area. Musk even outlined ambitions for Shy to have 50 million H100 equivalent GPUs online within 5 years. Elon Musk during the Q&A emphasized this as a strategic pivot, from pure EV maker to an AI and robotics-first company. However, he called the next several quarters a weird transition period, and warned of potential headwinds from expiring U.S. EV incentives, which are directly impacting profitability, as well as geopolitical uncertainties and tariffs that have increased costs. He also hinted at wanting a larger stake in Tesla to ensure its direction, but not so much control that he couldn't be removed. How did the market react? TSLA stock dropped 4 to 6% in after-hours trading. Some analysts remain bullish, especially Wedbush's Dan Ives, who sees these earnings as the start of Tesla's AI future and is raising long-term targets due to the potential of Robotaxis and AI. Like Ross Gerber, are more cautious, calling the Q2 report garbage and citing cash flow weakness and continued auto revenue declines. Let's break it down with a SWOT analysis snapshot on Tesla. Current status. Alright, let's dive into a quick snapshot of Tesla's situation, starting with their strengths. First off, Tesla has really robust cash reserves. We're talking about $36.8 billion. That's a massive financial cushion, helping them weather any storms. Then there's that strong product pipeline. Think about it. The anticipated affordable car, their Robotaxi service, and all the incredible advancements they're making in AI and the Optimus robot. These are serious avenues for future growth. Don't forget their services, revenue expansion. This is a growing and increasingly important segment for them, bringing in a steady stream of recurring income. And finally, their energy storage strength continues to impress. We're seeing consistent deployment growth in their Megapack and Powerwall units. Now, onto the flip side. The weaknesses. A big one is profit margin erosion. We've seen significant compression in their operating margins, largely due to pricing pressure in the market and a decline in those valuable regulatory credits. That leads directly to the next point. weak auto demand and pricing pressure. This is causing lower average selling prices and a drop in overall deliveries. Speaking of those credits, the regulatory credit shrinking is a substantial revenue stream that's just diminishing. It's directly impacting their bottom line. And let's be honest, their aging vehicle lineup is contributing to cooling demand, especially when you compare it to some of the newer, fresher, competitive models out there. But where are the opportunities for Tesla? A huge one is the Robotaxi rollout across multiple cities. Expanding that, Austin Pilot could truly unlock a whole new high-margin mobility service for them. Imagine fully autonomous taxis everywhere. The energy and services business still has plenty of room to grow. Continued expansion and profitability in these segments can really help diversify their revenue streams beyond just car sales. There's also the potential entry into massive markets like India. Tapping into that new demand could be a game changer for their global reach. And of course, full self-driving, or FSD advancements. Further, refinement and wider adoption of FSD could be a significant differentiator and a huge revenue driver down the road. Finally, let's talk about the threats that Tesla faces. There's the looming expiration of EV credits. This directly impacts sales and profitability, especially in places like the US. Then, the intensifying global competition. We're seeing it from aggressive and innovative Chinese EV manufacturers who are really coming on strong. Political and tariff uncertainty is always a factor. Geopolitical tensions and evolving trade policies, especially concerning China, pose real risks to their operations and sales. There's also the execution risk on new initiatives, the success of big projects like Robotaxi, and we can't ignore the CEO controversies. Elon Musk's public persona and his political activism have, at times, been cited as potentially harming the brand's perception. In the short term, we're likely to see potentially rocky quarters as Tesla deals with declining incentives, continued volume pressure, and reduced credit revenue. The focus will be on managing these headwinds, while setting the stage for future products. In the mid to long term, if Tesla successfully executes on its ambitious AI and autonomy roadmap, including the wide rollout of mass production of affordable models, and the commercialization of Optimus Sit, could unlock entirely new high-margin revenue streams that could fundamentally transform the company. But this is clearly a multi-year bet that requires significant capital expenditure and flawless execution. So, if you've made it this far, here is the summary for investors. Q2 shows a marked slowdown across key financial metrics: falling revenue, shrinking margins, and significantly reduced cash flow from operations. However, this quarter also highlighted that foundational moves are being made toward AI and fleet services, demonstrating a clear strategic pivot. Key risks for investors to watch include macroeconomic incentives, execution in bringing the affordable model to high volume, and navigating regulatory hurdles for autonomous driving. Keep a very close eye on the next few quarters specifically. Look for initial ramp-up figures for the affordable model and expansion metrics for the Robotaxi service. These will be critical indicators of whether Tesla can successfully transition from its current automotive challenges to its future vision. And that brings us to the end of today's financial deep dive on Tesla Q2 2025 results. If you got value from this, please give us a like, subscribe, and hit that notification bell. This is the Investment Diary. See you next time, where we decode the top investment stories shaping our world. What are your thoughts on Tesla's strategic pivot? Do you think the focus on AI and Robotaxis will pay off? Or is it too big of a gamble given the current automotive head? Let us know in the comments below.